when you increase lifetime value of a customer, you can then spend more money to acquire those customers. And so you're lifting all ships, right? You're lifting revenue, you're lifting profitability, you're creating more value. And so we're experts at that. We know how to do it, and we've done it a lot of times. And now we have a formula that works, and we're applying that formula to new acquisitions.
Hello, everyone. Welcome to Christina's Room Business Podcast. We have a very interesting new episode today. We will immerse ourselves in cybersecurity and acquisitions, but not any type of cybersecurity, more specifically consumer-based cybersecurity with a focus on privacy issues. And we have many things to discuss with our guest today, with Gary Guseinov, the co-founder and also CEO of Real Defense. And Real Defense is a holding company. So we will talk about holdings to understand a little bit more what is also behind such a company, because many people may be confused between private equity or VC and holdings. So we will have many clarifying questions for entrepreneurs, founders, and especially those who want to build in this space of cybersecurity, consumer-based, and also who want to create a company for acquisition reasons and want to have more insights. And we will see in what direction we are going. Welcome to the show, Gary.
Thank you for having me.
I love your background, especially because I see a very nice transition from a typical entrepreneur who started a small company that just became private. So you got to 100 million revenue, I presume annually, right? And then you became a private, you were listed on NASDAQ. And so that's a huge achievement by itself. And then you continued in this space because you do have some decades with the internet. You have a close relationship. And I would just love you to pinpoint some of your important timelines from your first company or Cyber Defender, the one that was listed on NASDAQ, and today's holding company, because you do have some different interests, like at the beginning as a typical entrepreneur.
Sure. Yeah, that's a very good overview. And so I started in direct response advertising in the late 90s. So right as the internet became what it is today. And not a lot of companies understood advertising, how to acquire customers online. I started an agency, and the agency was buying and selling advertising. We had Fortune 500 clients, did really well. Became profitable year one. And so I subsequently left the company, sold my interest, and started a company called Cyber Defender in 2003. And the company was profitable year one again. We were very focused on building technology products for consumers and the privacy and security space. And we took the company public in 2007, I believe 2008. Company went to NASDAQ, grew really rapidly. Facing challenges as a public company, challenges from across all spectrums of the business. I left the company in 2011, and the company had continued to struggle at that point. And I came back and bought the company back in 2017 through a structured buyout. And we've raised about $50 million for Real Defense. We've been acquiring companies since 2017 very profitably. And we focus on consumer privacy because it's one area of opportunity. There's not a lot of technology in this space. There's not a lot of understanding of how privacy should work. There's not a lot of standards. And so consumers are kind of on their own. And we're trying to figure this out right now with technology that we're building, and trying to figure out what standards we can promote and how we can protect consumers.
Do you consider yourself a visionary more or a pragmatic? Because I can see that you twice, everything you started first year, it just went well. So this shows a lot of good planning or just a great intuition about what to do. So how would you describe yourself as a personality?
I like to see trends, and I kind of follow trends, and don't want to be too innovative, because if you're too innovative and too early in the process, you could just keep wasting money. You're going to burn cash. And it's okay to do that if you have a lot of cash. So if you want to wait, let's say 5, 10 years to realize your dream, you can do so. There's nothing wrong with that. I was looking for opportunities that have a shorter time frame for return on investment. So within a year, maybe even less. And the only way to do that is to enter into a space that's already being built or emerging, or it's already a trend, and maximize opportunity by being number one or being a competitor in the space. So we at Real Defense, we identified those opportunities. We've been a trendsetter. We do have own one category that's very much we're dominant in, and we are so good at it that most companies in our space license our technology. So we probably have 90% of the market right now.
You have 1 million paying customers or over, right? That's huge currently.
Yeah, over 1 million. Yeah.
Over 1 million, yes. And this shows how many companies do you have now in your holding?
For Real Defense, it's four companies that we've acquired in the past 4 years. So
one company per year, statistically.
Yeah, it almost turns out that way. We did 2 acquisitions last year, 1 year prior to that, and another one prior to that. So, yeah.
I see a very pragmatic, opportunistic approach here. And I saw this, in the acquisition space a lot with people who are playing in this, that they usually construct something very specifically in their mind, what they expect in the future to happen. And so they start day one constructing that company with this particular vision that, okay, I will list this company, I will sell it, I will just let myself acquire. So to identify yourself in this kind of vision, right? And you also have social engineering as your background with psychology. Do you think that this too helped you to go into this space?
Yeah, it helps. I think it helps a little bit, or maybe a lot. I think it's understanding consumer behavior, really important. Also understanding how the bad guys operate and what kind of tactics they use for social engineering. And what we're finding is that there's just a lack of education out there on the consumer side. It's not necessarily the technology is going to be like the ultimate solution for all of these things, all these problems that are happening in the privacy and security spectrum. But also consumers need to be just more aware of what to do and what not to do. And so that awareness isn't particularly created by anyone. Your bank doesn't teach you how to be secure online. The government doesn't teach you how to be secure online. I don't mean that in a direct sense. There are websites and there's lots of content out there that the government produces and tries to get in front of consumers. But the practical reality is that most consumers are not aware of this content. They're not presented with it. Your bank, for example, who should be the one taking a lot of precautionary steps to protect your money, doesn't really do anything to tell you how to protect your money. They give you a username and password and say, use this to access your bank account. But that's not adequate amount of security to protect your money. And so, they were so behind in terms of education and infrastructure, compliance. It's not nowhere near where it needs to be. So it's a lot of opportunity for businesses like ours and new businesses to create products and services in the spectrum.
You went all into this domain, consumer privacy, and especially you don't have as much competition because people usually went to corporate side. It pays better, it's easier to enter and high entry point and bigger rewards. So you expect something to happen, I believe. You expect the tipping point that consumer privacy and security gets into highlight, especially now after COVID. When do you think this tipping point will occur, and based on what kind of circumstances?
Well, there are a lot of dynamics that are happening in the world when it comes to privacy. First, you've got no standards that companies need to comply with in terms of privacy infrastructure. Like, for instance, there's data privacy. Data can't be shared a certain way. In the medical industry, there's HIPAA, and other industries and finances, all kinds of rules around how financial information can be shared. But when it comes to general information, like, for instance, when you go to Google and you type in a keyword, well, what happens with that information? How is that information shared? There's not a lot of standards that play in that spectrum. or rules or consumer awareness. It's all wild, wild west for now. And so uh, then you've got consumers who don't understand where their data is, what's happening with their data, whether or not they've given permission to a particular company to use their data. And so the good guys, well, most businesses are not bad businesses. Most businesses are not trying to steal from consumers. That's not what we're advocating. And we also understand that advertising needs to coexist with consumers and with all businesses. Advertising is the engine behind everything we have, right? You have to advertise a product in order for someone to make money and for someone to use the product, right? So there's a need for that. What's missing is our standards and protocol and compliance, and there's no oversight. Our government, and not just the United States government, no government around the world understands technology. So when you watch these congressional hearings and you see like Facebook and Google CEOs go and talk to Congress, listen to the questions they're being asked. These are questions that should have been asked 10, 15 years ago. And they're still dealing with a very archaic sort of approach to technology. And I think it's lack of understanding. I don't think I don't think that Facebook is particularly smarter than our government. I think they're just ahead of the government. And so the government doesn't know how to apply rules and regulation to something they don't understand. That's why Bitcoin hasn't been fully adopted. It's very simple. No one understands it. And so how do you adopt something you can't understand? And that's why we're at where we're at today.
And where do you think this kind of moment will occur? Because, what I've noticed is that consumers became pretty much compliant. I don't care where my data goes, what happens. So I truly believe that it needs something to happen in a row, some events, some real security events that will just create a huge awareness, or the governments together will gather and they will see the danger, they will know about this beforehand, and they will start to create measures. What do you think it will happen first?
Well, that's a difficult question to answer because let me give you a practical example. Let's say that you transact with an e-commerce website and you set up an account with this website and you bought something from this website, and they now have your username and password and they have your credit card information. Let's say a hacker breaks into that website, steals your username and password and your credit card information, and goes on a shopping spree. Well, your credit card company will refund you on that transaction. So you're not going to be out of money. But what they can't do, no one can do, is take that username and password, your favorite color, your date of birth, your mother's maiden name, your mother's birthday, that information, if that information is stolen, it cannot be changed. Unless you change it with stop using that information, start using new information. And so most people don't do that. So the bad guys are piecing together your profile, your persona in the cloud. They're taking pieces of your information. And so then when they put it together, they can sell it as a package to another bad guy and say, hey, look, if you want this person's information, all their credentials, all their passwords they've used in the past, their personal preferences, here they are for $5 a user record. Now, how do you connect that event to the person or the company that lost your data in the first place? You can't, because there's no direct correlation between the crime and the company who caused it to happen in the first place. So there's no penalty. There's no lawsuit out there that says company XYZ lost data of 1 million people, and now all these cyber crimes happen because of that data loss. You couldn't prove that in court, right? And so until that happens, until we can take data that's stolen and connect it to a crime, we're not going to be able to connect liability and pain for companies who don't protect consumer data. And so, there's an opportunity here, opportunities for create data layers or security layers that kind of take the data points and put them in a box. And this could be blockchain or some derivative of blockchain, so that any data that's stolen has a record of it traveling from one entity to another, from one IP address to another, not one server to another, one e-wallet to another wallet. And then we can trace it back somehow. But until that happens, or we lock everything down so that no data is shared, that's another option. And so if no data is shared, we have to have fingerprinting. digital fingerprinting. And so digital fingerprinting carries its own risks and problems with it, right? Because for obvious reasons. And so this is a big, big, big opportunity. It's also lots of unknowns. There's no standards. There's no path. And so we're addressing it at one layer at a time, one opportunity at a time, to hopefully come up with a product or service that kind of encompasses these concerns and creates better environment for everyone. But we're far away from that.
It's obvious that we have an unknown future when it comes to security. And I'm curious here, based on what you said, where do you want to shine with real defense? Because this is such a huge space.
Well, we want to shine in an area where we can deliver a solution that's not dependent on the operating system, the browser, and exists on its own and tells you as a consumer what is going on with your information, how it's being misused, and gives you the ability to block and tackle these events in real time. So if you're being tracked right now, we want to tell you that you are, and then give you opportunity to stop this particular tracking from tracking you. If you are, using a mobile device and you're walking through the shopping mall and there's beacons out there that track your movements, we want to tell you that. You should have the right to say no or to say yes. For instance, you want to be tracked by certain brands. If you like a certain brand, why not give them the permission to know what you're doing, or a particular website, like you're doing business with a bank? Why not tell the bank what you're doing to help the bank to help you, right? So these are core benefits. But if there's an institution out there you don't do business with, but they want to know what you're doing for whatever reason, maybe you don't want to give them that permission. And so that's the balance we want to create. And hopefully we can make it so simple that consumers use it and actually benefit from it. That's a hard part, because you can talk about this technology all day long, but if no one understands it or uses it, what's the point?
Yeah, exactly. I was thinking about simplicity, because now it's even if we understand a little bit security, cybersecurity threats, bots, and so forth, we are still so far from a large acquisition like people to truly understand everywhere in the world what that means and what are the dangers. By the way, dangers, what do you think is the biggest danger today for me as a consumer being on the internet?
Social engineering attacks. So these are, can be as simple as a spoofed email that says, "Oh, it's an email from your bank. We're trying to make a deposit into your account, but your account is frozen. Please unlock it." And if you think it's legitimate, you're going to click on the link, put in your username and password, click unlock, and you go home and you say, "I'm done. I did my part. I did what I was asked to do." In the meantime, the bad guy is pulling money out of your account, doing all kinds of crazy stuff. And so social engineering is very difficult to maneuver around, because even the systems that are in place to protect that email from being delivered, a text message from being delivered, they oftentimes don't understand whether or not it's a bad actor or a good actor. Because again, we don't have standards, right? When the internet was built, there were no security standards, protocols built into the platform. And now we're in the same place. So 20 years or 30 years ago, since then, nothing's happened. So we have the secure socket layer, SSL, and there's all kinds of buzzwords that are out there. Those are not going to protect the consumer. And so we're in a place where the government ultimately would have to step in and create standards. I'll give you an example. If you buy a car, could you get a car in the United States without a bumper? No. And there's a reason for that, because the Department of Transportation says that a bumper needs to withstand a certain amount of impact on any car in America, sold in America. Why don't those standards exist in technology? If you build a website or an app or anything, should cybersecurity be part of your development cycle? Absolutely. If a car manufacturer made a car with no bumper and started selling it, in a store, they would go out of business day one, because they'd be shut down by the authorities. So that's a big distinction. This example is a perfect example of where we are with tech, online tech, however you want to classify mobile environments, desktops, iPads, iOS, Windows, same thing. There are no standards, and so and there's no one to blame. You can't say it's Windows' fault or Apple's fault or Microsoft. These companies are not the ones who are, creating this problem. And so, I wish there were some standards, some process you have to go through and say, hey, every app that goes out there on the internet, any website needs to go through some validation, some technology certification that says that they're not a bad actor. And they've blocked all the holes, and they're not going to do anything bad on your computer or your phone, and the data is safe, like all those basics.
So from this space, what do you think is the future of consumer security, let's say, during the next 5-10 years?
Consumers are going to ultimately take control of cybersecurity. That's my vision. I don't think that we're going to rely on anyone to make any changes. No government or no company come up with some underlying infrastructure that says, here's the new secure web. I don't think that's going to happen. What's going to happen is consumers are going to take control of their data. They're going to take control of their devices. I think metaverse could have an impact on this, where we simplify the communication streams and get rid of some technologies that are out there, like SMTP, HTTP, and all these protocols are very old. And in the metaverse, you don't particularly need them. So you can have a persona, you can have a virtual identity that is not utilizing these archaic technologies. And you don't need a phone number, you won't need an email address, you won't need to text people. It's all going to be done in a virtualized environment. And so I'm excited about that. I don't think it's obvious right now that we're going this direction, but when you start seeing applications for the educational field and medical field that are using virtualized environments to teach, you're going to see how that can be applied to regular consumers, and that's going to be really exciting. That's within the next 5 to 10 years.
What are the achievements you are most proud of? Because you do have a lot of them, like from the first company that was traded and afterwards, and now you also have a background of investor, board member, advisor, holding, CEO, and so forth. What do you consider your biggest achievement or achievements?
Well, I think that, any company that you start and you turn a profit and you get to grow it is an achievement, right? How many companies fail? If you look at just the percentages of companies that are started and succeed versus the ones that fail, most fail. And so I think that's an achievement. I think having a company that employs a lot of people, that's an achievement. I think that building technology that saves people from cybercrime is an achievement. I don't even know how many crimes we've prevented with our infrastructure. I wish I knew. It's probably millions of attacks, millions of events that our technology at some point blocked and tackled on the internet and for our consumers on their behalf. And so I think those are achievements. I think innovation is really important. In our current company, we're doing a lot of innovation on the privacy spectrum, and we're pretty excited about some of these efforts. We have some really, really smart people. Some of these guys are PhDs that are working on this, and it's exciting to see them come up with new ideas all the time and how to block and tackle some of the threats we talked about. So those are all really exciting. Filing for patents that are protected. I remember filing for a patent for a peer-to-peer cybersecurity platform. This was in 2006, I think. And literally the next day, Microsoft filed almost identical patent to us. And we all started clapping because we said, well, obviously they thought what we're doing is important, but they went out and filed a patent for the same thing. And so it's those are exciting areas of doing the kind of business we do.
What made you transition from entrepreneurship to holding CEO? Because there are many common things, but also different, because this time you have more companies to manage as one.
Right. Well, what we do at RailyDefense is very specific. We're extremely targeted in our acquisition, the companies that we buy, and we try to create synergy really quick. So that, you know, we have a very specific strategy. And we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create synergy really quick. So that, you know, we try to create syner that has to do with cost optimization. So we reduce operating expenses, and we optimize revenue by creating more value for consumers. So instead of them spending 20, 30, $40 a year or a month, we add more products and services, and we'll create bigger lifetime value. And so when you increase lifetime value of a customer, you can then spend more money to acquire those customers. And so you're lifting all ships, right? You're lifting revenue, you're lifting profitability, you're creating more value. And so we're experts at that. We know how to do it, and we've done it a lot of times. And now we have a formula that works, and we're applying that formula to new acquisitions.
Tell us about the process. So, what kind of company should come to you? In what stage? And what will happen with them?
Sure. So we look for companies that are doing anywhere between $1 million to $10 million of 12 months trailing EBITDA. So profitable businesses that can be flat or declining, but they have to have a minimum of profitability per year. And then hopefully recurring revenue or subscription product, SaaS. Hopefully a relatively large customer base of tens of thousands or more subscribers. And we're not so focused on technology. They don't have to have any technology proprietary to them, but we like to have companies that build or use technology to generate revenue. So, and then what happens with the company? So once the acquisition is complete, we try to keep everyone on board. Our goal is not to let anyone go. We want to keep as much of the company intact as possible. We want to give the employees who may not have had raises or opportunities to make more money, to pay them more money. That's the first thing we'll probably do after the acquisition. And then we provide new guidance, new goals to the team. We get them excited about the future. And usually these people want to stick around. They don't want to leave. They want to see it through. They want to see their vision through. And so we're not a typical sort of, I don't know how to compare us to, but like in private equity, there are companies whose only job is to come in and cut costs. They're not interested in the future, they're interested in growth and scale. They just want to reduce costs and let the company possibly even die over time, like a slow death, but generate profit in the process. So that's not what we do. We're the opposite of that. We want to see growth. We want to take a declining business and make it grow. If the company's growing, we want to make it grow faster. So we're the white knights. We come in and we make the opportunity, create an opportunity from where there wasn't one before. And so that's our process, and it's been working for us.
How many employees usually such a company has when it comes to you? Is possible to be just two co-founders, or usually they have a team of 1 to 5 people?
Yeah, we bought a company just recently that had 2 employees.
Mm-hmm.
Very profitable. We're happy to do that. And we bought another company recently that had 50. And so they're all still with the company.
And what happens next? So they will be part of a family, right? They will work together with other 3 companies in this case. How do you merge them? How do you make them blend and work well together?
Well, first of all, if the synergy is in the, like, let's say product category, like cybersecurity, for example, they have the same mindset. Like they're building products that protect consumers. And so at the end of the day, they're trying to make the best product there is. And so they're going to contribute their efforts and energy towards doing that. When you start diversifying products, like let's say you're a company that makes hardware and software, or you're a company that makes cybersecurity products and video editing tools. Like you've got people inside the company have different views on product development cycles, different ideas. That's difficult to manage for a large company or a diversified product company. So yes, there'll be clashes there within the organization. We don't have that. We're not big enough for that to happen, and we're not diversified enough product in such a way where our products are competing with each other or they're not in the same vertical. So we don't see it as a problem. And also today you have remote workers, you have people who want to come to the office. If there's a cultural clash, that person can work from home and not conflict with anyone. If that was the case, we don't have those problems, but if you have a company that's doing acquisitions and they have cultural issues, they could offer some employees to work from home so they're not conflicting with the ones in the office.
What happens if the co-founders want to leave? Do you have some clauses at the beginning, at least to stay 1 year with us? Or no, you can leave if you have a team and we know what to do with your product?
Yeah, so typically what happens in an acquisition, if we need the management to stay or the owners to stay, we'll ask them for some tenure commitment. So they'll say a year, 6 months, 3 months, 2 years, whatever makes sense. And then we'll sign an agreement, employment contract, and they'll have maybe an earn-out or some extra stock that they're going to earn during the process. And we'll agree to it prior to the acquisition being completed, and hopefully everyone's happy at the end. We tend to be buyers of companies that are divestitures of larger companies. So you'll have, let's say, $1 billion company that has a $10 million company they want to sell. So the CEO of the big company is not coming with the transaction. It's usually the operators of that company. They could be VP level engineers, whoever is running that business. And so we're not having to deal with the CEO who's going to have to come with the sale. We haven't had that happen yet. So, but in general, that's what you would do. If you're buying a company and you're not going to run it, someone else is going to run it, that person needs to stick around.
Okay. What should be the first reason for a company to want to come to you? That's one. And what would be the first reason why companies usually come to you? Because it could be different. I don't know if it's the same answer, perfect, but maybe it's a difference.
Yeah, so there's a couple of reasons. One is we're very fast when we make a decision to buy. We move very quickly. We have a process in place. We have an internal M&A team. We have lawyers. We have financial analysts. We do what's called quality of earnings, which is the underwriting of companies' financials. We understand how the revenue is generated. We look at the audited financials, all that. That process could take months or it can take weeks. And we can do it fairly quickly because we have a team that's trained and knows what to do. Legal process, same thing. We look at obligations, we look at all the contracts. So we have a process built to do that. We tend to do most deals cash at closing. In other words, at the end of the exclusivity period and during the time of due diligence, right at the point like at the time we do the close, we try to fund the company with most of the cash that we agree, all of the cash that we agree to at the time of closing. So that we don't have like these complex deals where you get 20% of money now and 30% later and 40% later. Those deals tend to have high valuations, but low probability of you collecting your money. So, because what happens with deals like that, the buyer will usually say, "Oh, you misrepresented this fact to us during diligence process, so I'm not going to pay you what I owe you." And then they get into a lawsuit. And so we try to avoid lawsuits, try to avoid discrepancies in what we've agreed to buy by doing really deep diligence in the beginning, and then telling the seller that we're going to give them most of the money of the valuation at the end of the close, and maybe a little small amount of money is more like an insurance policy for 12 months that we will pay out over time to make sure that there's no discrepancies in the company data that they provided to us. So that's our approach. So we're just more transparent, we're close faster, and we pay mostly cash at close. That's not how most companies operate who do acquisitions. That's not typical. And we're not premium buyers. In other words, we don't pay premium valuations because of that. There are companies who pay premium valuations, but they also can drag you into a lawsuit, or they can pay you over a long period of time, which means you're not going to see money at close. So you got to understand, as a seller, you really need to understand the difference. And a lot of times sellers only see one number, the valuation, and they get excited and they say, "Oh my God, these guys are paying me 10 times profit or revenue, and you're offering me 5 times," but they don't see the small print that says, "Oh, that's not at closing, that's over a period of 3 years. And some of it is carried financing by the seller, and some of it is in stock, and some of it is publicly traded stock that you can't sell right away. Like there's all these caveats, you need to really know what you're doing.
What's the vision you have? How big you want to grow? Because as far as I understood, you are very open to just acquire promising companies, as many as possible. How many could you acquire if they would come to you during the next 12 months?
Well, we have some capacity in terms of our staff. My team has done hundreds of acquisitions, and so this company has done a handful, but our team has done hundreds of transactions. We've raised billions of dollars, so we can do a lot. If we had to do one acquisition a week, we could probably do it, but we would have to have priorities set correctly. We would have to have the financing set for this kind of volume of acquisitions. And so you also get very sloppy if you're doing a lot of transactions. You start missing things and you start getting into lawsuits and things will start breaking. So there's no benefit to doing lots of acquisitions too quickly. There's no inherent benefit unless you're a publicly traded company trying to create value. You can't do it organically. You got to do it through M&A. Then, if you're a multi-billion-dollar company, these companies are doing one acquisition every couple of weeks. But these companies have hundreds of people in their M&A team that do this. Lawyers, BD people, corp dev, like Intel, Yahoo, or Google, massive teams. And so we're not that size.
And as far as I understood, you would love to have this kind of problem, but today there are not so many companies you could acquire, and you encourage everyone to enter in this open space because usually there is a confusion about corporate security and private security, right, for consumer. And so in consumer security, there is not a big competition. And so you would love to be more to approach the future you are telling me about?
We particularly, Real Defense does not invest into startups. That's not our, we don't know how to do it. We don't have that expertise in-house. We don't know how to value them or shepherd them to success. But
okay, so how seasoned it should be for you to consider it?
Sure. They should be generating at least $1 million in 12 months trailing EBITDA. In other words, for the past 12 months, they should be generating at least $1 million in profit or more in order for us to look at it, in order for us to consider it. Otherwise, it's too small for us. There are other companies out there who buy smaller companies for their technology or for something else. Our charters or our directive from our board and our investors is to stay in this range. And so we find companies like this here and there. They're not obviously available out there. It's really hard to find them, but we do have a pretty decent deal flow of companies coming to us specifically in this range. And so we're constantly in negotiations with someone. At any given day, like there's a negotiation going on with some acquisition target. But if a company's got some really cool tech, they don't have the profit, they have revenue, maybe no revenue. There are buyers out there, people who are looking for, particularly in the enterprise space, you don't need to have revenue. You just have to have a good product that works and hopefully beta customers that are just using your technology. So if you got that, you're a candidate to be taken out by someone. And it may not be us, but there's others out there, particularly in the enterprise space, that are constantly looking for deals like this.
So cash flow is a very important aspect for you. To have a steady cash flow already, it's an established business. It should have problems because they don't know how to manage or go to the next stage, or something is missing inside the management. And you just see the opportunity that on the right hands, they could just continue very nice growth. And also you are long-term focused. So this is important to know for an entrepreneur who wants to sell in this space to you, that you don't want to just cash out. You truly want a healthy business that just grows and generates more and more revenue with a healthy team and a consumer-centric approach with the value-driven products and services, right?
That's right. We're only interested in continuing our path and to keep doing what we're doing, building on top of our existing strategy. And we're not looking particularly to sell or go public. We're not looking for that. If it happens, it happens. But we're not building to sell. We're long-term play. If we stay private for the next 20 years and continue doing what we're doing, that's what we're going to
Now, what type of businesses at the general level should consider acquisition and not VC money?
Well, it depends. Like if you're a founder,
From a
and
founder perspective, like
yeah,
what would be more suited?
sure. If you don't want to run your business, then clearly you want someone to buy it because VCs want to invest into a management team. They trust the management team, right? So they're not going to necessarily be excited if you say, "Oh, I want to raise money, but I'm leaving." Now, if you had a second person in command or another management team that can take over from you and they were fully engaged and aware how to run the business and have had a track record of success, then VCs will participate in something like that. But generally speaking, you're probably better off selling because you're not going to have this issue with the buyer. They may say, "Oh, fine, you want to leave? That's okay. We'll take the company and we'll run it ourselves." Um, in terms of raising venture money, I don't particularly like it because of the dilution it causes. I'd much rather borrow money than take equity. If I believe in my business and I'm doing well, why would I give up equity? That doesn't make any sense. But if you want a partner and you want no risk of capital, in other words, you don't want to be making a payment every month to a bank, then you can take equity. Let's say you own a lot of equity in your company. You may want to sell some equity, put some money in your own pocket, and then take some of the money, put it on the balance sheet of the business so the business can grow and bring on a good partner. There's a lot of VCs out there who are good partners. They're going to help you grow. They're going to help you acquire companies. They're going to ultimately help you sell because they have a network. And so, from that standpoint, having an institutional backer, a VC, could be extremely valuable. But some businesses shouldn't take venture money. If they're growing really well, they have profit, they have a good product, they should keep their equity as long as they can, because that exit at the end is going to make a difference in terms of making X amount of dollars or versus much less money if you've diluted yourself. Plus, taking money from an institution isn't as simple as going to a bank and getting a credit card. These people are on your board. They have preferences. They have certain liquidation preferences that happen after you sell. They get paid first, and then how they get paid is also going to be in their favor. And so you got to really understand the structure of venture money before you bring it on. Debt is a lot less complicated than equity, far less complicated. It's just more painful because you're making a payment every month. But in terms of impact on your business from an equity standpoint, venture money is far more complicated.
That's so good. I do agree with that. What do you think it would be the recipe of success from you as a professional now in acquisition to someone who does have a company and it's on the right path, but it's not there yet? It will be. So I want to sell my company in 1-2 years, and I'm close to those figures, but I still need those 2 years, let's say. But now, depending or accepting the money, what should I focus on as a recipe that you will just like be super crazy to buy my company?
Sure. Well, the most fundamental is the number, the profitability number. That's the most fundamental one. That's the first thing we look at. Then we look at, well, I should say, let me rephrase that. If you have, let's say, a company that has a subscriber base, you're generating, let's say, 10 million in revenue, and you're not profitable. But when we look at your financials, we see that you're spending too much on advertising, or you have too many people in your company that are not attributing to the profitability. You're overweight in some areas of your business. Then we can look at that and say, okay, if we own the business, would we be able to fix this? And if the answer is yes, and it has to be very obvious, like I'll give you one obvious one. If you have a lease for office space and that lease is $50,000 a month, and you don't need all that space. You can work from home, for example, and I can eliminate $600,000 spends from your profit and loss. Then I'm going to get really excited about that because I know I can get out of that lease. There's a way to renegotiate these leases, buy them out, cut the term, pay a penalty, whatever. So that would be another way to look at a business that's losing money and turn it into a profit center. Another one is just, what are you selling? Are you selling in the way that we could optimize so that we can create more value from each transaction, upsell customers better, put in a better billing platform, put in a better e-commerce platform, do better upselling and cross-selling post-purchase, like all those blocking and tackling that can be done with a consumer business. So we look at those areas. Now in terms of what's ideal is when you have a recurring revenue, that you have low churn rates, that your product is liked by consumers, that they really want it and need it, that it rates high amongst its peers, that you have if it's a tech company, hopefully you have engineers, you're not licensing all your code from a third party, that you follow standards like industry practices, and you follow some rules in terms of how you build your product, that you have documentation, that you have code that's documented and easily readable by a person who didn't build it, right? So your books are in check, that you're audited financials once a year, you have a CPA we can call and have a conversation with. These are not obvious things in a small business. You'll be amazed how many small businesses don't have these things. And we have to create them. We have to get the financials audited. We have to make sure that the code is documented and easily understood by our coders and our developers and engineers. So, it precludes you from going down in some size. So you start looking at a business and you want all these great things, you're going to get that in a larger company, not in a small company.
Yeah, I love that you mentioned an interesting difference that is related to what you said, because basically you are looking for healthy businesses, the way things should be. But when it comes to venture capital, many times the founders or the companies that acquire venture capital have not even 10% of what you're looking from the people you are working with and companies. Why do you think is this discrepancy? Because basically you shouldn't just look for the hype and how attractive a company is, but how healthy it is. And you described a healthy company, but in the VC world, many times you acquire not exactly healthy companies, or where the founders don't even know how to run, but they do have a good marketing campaign and they did acquire some traction based on a lot of help and maybe some money.
Yeah, look, most problems in a company can be solved with cash. If you have enough money, you can solve almost any problem. VCs know that. And so VCs also, if you look at the checks that are being written now versus 20 years ago, 10 years ago, 30 years ago, they're much larger. The average check size is larger. And so the reason for that is because you have more runway. If the company screws up in, let's say, first couple of years, they still have enough money to fix things and turn things around and move on, right? And a startup needs to have that flexibility, because sometimes you go in with one idea and then you turn around and 6 months later you say, you know what, this didn't work, but this might work, and you do it. If you look at Facebook, for example, we don't know how many iterations Facebook has made to get to where they are, right? You only see this behemoth, right? This $1 trillion business, and you say, oh my God, one day Mark Zuckerberg woke up and then boom, here's Facebook, right? He probably failed 90% of the times in execution. In other words, new product goes out, didn't work. New feature goes out, doesn't work. And keep doing it over and over and over until you get it right. Because that process can take years and it can cost a lot of money. In a company like Facebook, that can cost hundreds of millions of dollars, if not billions, right? So as an entrepreneur, you got to go in there with that mindset that you're not going to hit, it's not a lottery. Okay. It's like, you're not looking to try a bunch of numbers, right? And so this is scientific, and there's some art involved, and you got to have a path, but it doesn't guarantee outcome. And also the outcome may not be exactly what you want. It's slightly off. And so you have to tilt and pivot to get it right. And so these movements, if you're self-funded and you don't have a lot of cash that you have on your own, you're going to struggle and you go out of business. That's why a lot of businesses go out of business. They get one bad month and suddenly they have no cash. And so VCs are perfect for these days. If you have this, VC is your friend because you have cash. If you need more, they'll give you more. You have all your equity. You can sell it, But I've seen the opposite happen. I have friends who are entrepreneurs and never taken a dime from outside investors, and no friends and family, no VCs. Everything is homegrown, credit cards and mortgages against their house, and they've done wonders. They're millionaires. They continue to be over the past decade. They've never taken any money from the outside and don't want to sell their businesses. There are a lot of companies like that out there. You just don't hear about them because they're not in the news. There's no benefit to a third party from them being in the news.
It's also so important. Yeah.
Well, that's why I'm saying, you only hear about venture-backed companies, right?
Like being the recipe for success, but it's so, so important for the recipe of happiness and joy in life and purpose, even to identify what type of founder you are, because I noticed that many times it's just the external pressure that, oh, this is how I should look like. And when you don't know yourself and you just immerse yourself in the VC world, but you're not prepared and you are not the typology for that, you become very miserable very quickly. On the other hand, if you are prepared for that, you identify that that's the road that's perfect. Same with acquisition, same with bootstrapping, and just have a business that generates revenue for you and you don't complicate yourself with anything else. And this is your purpose. It's good to define that. And I would love to know your own perfect definition for traction.
Traction? Well, in my business, I have one way to look at that because I only see it in my my understanding of what traction is in our business. And so that's recurring revenue and churn. And so it's very simple approach to SaaS valuations. You've got a product that you're selling. Hopefully, you're adding customers every month and not flat or losing them. And hopefully, they're sticking around and not leaving faster than they're coming. Okay, and so if you have that, and it's more than 15 to 20% year over year, that means you've got some traction. And so for us, that's interesting enough for us to engage in the conversation and come up with a structure. But traction could be valued differently by other people. Traction could be just users. How many free users do you have? Or how many interactions with those users do you have? Or just revenue. Are you creating more revenue every year or more profit every year? There's different ways to look at it. In Silicon Valley, for a long time, there was traction was how many users you have. Didn't matter if they paid, as long as they're users. And so, look at WhatsApp acquisition, right? It's a perfect example. Not a lot of revenue, just lots of users. And so that is still, there's some areas of technology companies that still rely on that metric as a barometer of success and traction, because they figured at some point these are paying customers. And that's perfectly fine because it's true. It can be true. And if you know what to do, if you know how to monetize. Zuckerberg did that. He did that with WhatsApp. He did that with Instagram. And look at these businesses today. Google did that with YouTube. YouTube wasn't making that much money when they bought it for $1 billion. And then look at it now. It's a behemoth. And so these companies know how to monetize these types of assets. Most people don't know how to do it. So if you know explicitly how to do that, do it. If you don't know how to do it, don't think that you're going to figure it out. You probably will not figure it out. So don't do it. Focus on things you know how to do.
I ask this because, it's traction is basically the holy grail lately. With my clients, their first focus is traction. I had this so many times, so I created my own research during the last couple of months on my channels, to polls and so forth, to see that was identified as the first issue and for different stages. So it's not just pre-seed, it's also seed and Series A+. So that was interesting to see. And then we went in specifics, and I just had a masterclass just because I noticed that this is such a big issue. That's why I was asking. And now if we would reward a little bit what you said, and I would want to quote you. So create a very nice imagery with a quote from Gary Guseinov about traction. Traction is
growth in recurring revenue.
Perfect. Thank you. So now I'm curious if I should resume everything what you said today, very fascinating, by the way. And I think that my audience can learn a lot from you and your views, especially in this space, because the way I see it, we are pretty much at the first stage when it comes to innovation and how much we can grow, especially in consumer cybersecurity and in privacy issues. We are like newborn, I would say. I noticed that there was a lot of innovation in products, especially, but they just don't connect with each other. And maybe that's why we don't have the regulations, also the lack of communication and the lack of understanding also with the current world of AI. So we do have a lot of solutions, but they're just not connected or they don't know about each other. And at some point, everything will just like be like, boom, oh my God, we need to do something about this. And we will have that huge hype. But still, we are in infancy when it comes to this space. This is what I understood. And also, because the internet in general, it's still such a big unknown, especially that now we have the AI. How do you see AI affecting what will happen in consumer security and privacy? How could we leverage AI during the coming years? And what are the dangers if we don't do it right?
Sure. So, I mean, look, I think AI is terminology used too broadly, and I don't particularly find it defined in any way that's clear, in any industry. So, for instance, in finance, there are people who talk about artificial intelligence as a method of predicting success of a particular stock. That doesn't mean that same computer is going to cook a meal for you, okay? Or that same computer, that same AI is going to go to war on its own, right? These are all very specific areas of technology and specific areas of industry that have created machine learning, have created really good tech for predictability of events. That's not AI, okay? So artificial intelligence basically says a computer can think on their own, okay? We have not had that yet. I haven't seen it. I haven't seen any technology or any industry where a computer that can think on their own, or technology can think on their own, can predict an unknown event that it hasn't been programmed to predict. So that's AI. But if you say to a computer, look, I'm giving you a bunch of data points, find a trend in these data points. Well, a computer's going to do that because you told it to do that, right? You programmed it to do that. But to have true AI, which is like if you've seen that movie Artificial Intelligence, where that the boy has the little bear that's driven by artificial intelligence, that's closer to AI than anything else because this bear, the computer that's in his head, is able to articulate things around it that a human may not understand. Like for instance, self-driving cars. How come we don't have them yet? Because the AI that's supposed to be driving these cars doesn't exist. AI does not know the difference between a mouse crossing the street or a human. It doesn't know how to make a left turn because it needs to have all this data in order to figure out how to articulate a turn. A human doesn't need that, right? A human can use peripheral vision and can make so many decisions based on peripheral vision. And so we're not there yet. I think the fears that are out there, they're not real. I think the concerns are not real. There's no real true AI out there. There's highly sophisticated predictive systems out there for specific industries. That exists. True AI, in my opinion, does not exist yet.
Interesting perspective, because this is a never-ending debate about AI, and I was also co-founder in two AI companies, so we could enter in this space. But I do agree that what people understand from what we truly have today as technology is far, far beyond the hype in the news, because there are so many things in the background to be truly addressed as being AI and doing a good job. So yeah, here a lot of innovation is still needed, and I would say open communication. So open sources being now present and people enabling such a collaboration is a huge big step forward to what we truly need. Because when it comes to AI, you need to take it as a holistic approach, and there is no barriers. There are no like separation between countries based on ethnicity and where we have the border. We do need to tackle this together as a one nation all over the globe. This is the way I see it. Now switching gears a little bit, just because I do have your example. You decided to have a holding and you love it because you do have your successful entrepreneurial background. So if someone wants to do as you do, I did had my share as an entrepreneur. I did have a success, and now I don't want exactly the VC word. I want your word to be in acquisition and create myself a holding. What should I prepare for?
Well, when you say you create a holding company with different companies underneath it.
Exactly like yours. Yes.
You need to first come up with cash that you're willing to invest, whatever that dollar amount is. That could be friends and family, it could be your own money. So some pool of money that you're going to invest. Mm-hmm. Then you have to find a financial partner that's willing to give you leverage against that cash. So it's like a bank when you're buying a house. You put 10% down, the bank puts up 90%, you put up 10%. Same thing in a business transaction. Same thing.
What was your percentage at the beginning compared to your financial partners?
In terms of ownership of the
yes.
A significant amount. And let me explain the difference between equity and debt. Okay. Mm-hmm. When you form a new company for the purposes of buying other companies, and your vehicle to buy other companies is debt, not equity. In other words, you're borrowing money from a bank to buy other companies. Your equity is not shared with the bank. The bank doesn't have any equity in your deals. You have the equity. So you have 100% of the equity. Now, that varies dramatically from deal to deal. So let's say you went to the bank and you said, give me $10 million. I'm going to put up $1 million. The bank puts up, give me $9 million. I put up $1 million, and we're going to buy a $10 million company. Okay. The bank might say, excellent. We want a little bit of, of the equity because we think you're going to be successful. We want to participate in the upside of the equity. And because of that, we're going to reduce the interest rate by 2 points. You may say, you know what, it's a lot of money. I'll give you, 10% or 5% of my equity in that scenario, right? But generally, the bank is not going to take your equity. You're going to keep your equity. So that's the difference between VC and a deal like I just described. But VCs are not in the business of M&A. They're in the business of financing your company. You have a new startup. They want to give you money because you're going to grow your business. What you're describing is not that. You're not an entrepreneur. You are a financier. You are a operator. You could say, I only want to buy companies that make, bookmarks. Okay, and I want to be the biggest bookmark manufacturer in the world. And I identified 10 companies that make bookmarks. I want to buy them all, and I need $100 million to do that. Great, but that's a great thesis. Do it, because banks and your sponsors or investors, whoever you may want to take your equity and divide it amongst a group of people that you trust that might be operators of the company. There might be your CFO, your COO, your president, your VP of marketing, or it could be just investors who are in the background who want to support you in your effort. You give them your thesis, your proposal, and they believe you or not believe you, and you go on to the races. The difference here is that the risk is much lower for them, you in the bank, than doing a startup by far, because you're buying assets that are already producing profit.
How did your CEO role change compared to your previous companies?
Not dramatically. I mean, I'm still an operator, so I'm day to day, hands on. It's just there's less risk, there's less confusion in terms of how the equity structure is going to be at the end of the day. Because when you're running your own business and you're constantly selling equity, when the day you have an exit, you made up with a lot less equity than what you currently have. And so you're always worried about that. It's like, when do I tip the scale, and what if I lose control, and all these things. And so with the current structure that I just explained, that is not going to be your fear. Your concerns is going to be, how do I continue growth, or how do I stabilize these assets that I acquired, and how do I retain my employees? Like, very basic sort of things that you would be concerned about in any company that you're running. But your financial fears are going to be less, because I don't say zero, but less, because you're not dependent on the venture capital structure.
You just answered my next question about what you should worry about in this new role. Yeah, perfect. So this was interesting, and there are many gems, and it was also condensed in a lot of information. Is there something you wanted to mention or clarify and I forgot to ask?
Well, this is a big area. There's lots of variables and lots of nuances to what we've been talking about. I think that entering the area of mergers and acquisitions and creating a holding company is a fairly complex area. There's lots of understanding you have to have of equity structures and debt and how to buy companies. And a lot of times it can go wrong. Like, if you can buy a company and end up in lawsuits. In fact, 15 to 20% of acquisitions end up in some sort of a litigation. And so you have to be really careful. And sometimes you can't assume that the person, whose company you're buying, looks at the world the way you do.
Right.
Right.
What would you love people to know about Real Defense today?
I would just, if you're a consumer, you should definitely use our products. If you are not a consumer and you're interested in just understanding M&A, look at our press releases. You can see what sort of financing we're using. There's some information that you can put to use. Probably watch us in terms of how we're growing. We're growing pretty consistently year over year, quarter to quarter, month over month. We're not public, so we don't divulge financial information. But yeah, those are the top of mind.
And now at the end, let's put a little bit more human-centric face over you, because this was a heavy discussion. Share us a hobby, a personal hobby not many people know about you and don't expect that you would have such a thing.
Oh, wow. Okay. So when I was younger, I used to be a DJ, and I still do that to this day. I ski, I bike, I do a lot of physical activities, whatever it is that I can find time for. Tennis, but my favorite sport is skiing. I like to ski in Europe, and try to go there every year.
What's your favorite resort in Europe?
Lech. That's in Austria.
Okay.
Very far from civilization. So, but
it's in Austria there are there are a lot of amazing resorts, and remote and isolated as well. Yeah. In Europe you find many.
I like the people there. They're very friendly. So, yeah.
And DJ, you are DJing today at parties?
I just did it for myself, but I used to DJ back when I was like in high school and early college. I was doing clubs and parties, things like that. So, yeah.
What type of music you would DJ?
House music. Right. Yeah, but we started out with European house. That's the kind of music we played. Nobody understood it in the United States. Nobody cared for it, and then slowly became really popular. And I remember kids back then asking for this kind of music to be played at parties instead of rap. It was pretty interesting to see the transition go from hip hop rap to house music. You want to talk
Awesome.
about house music? I can talk about house music. So,
Okay, we could create another episode just by talking about hobbies of entrepreneurs and founders, and also the connection with their success and what brings a hobby into your life and to your success, because it's also part of your mindset and your daily activities, and how everything connects in your mind basically and keeps you sane enough to pursue that success in a healthy way, correct?
right, right.
Ready for my last question? I started to just ask this recently, but I truly want to become my last question for everyone. So if I would be your genie and I gift you with all the influence and money in the world, what would you do with it?
Influence and money. That's an interesting question. I probably, address it with prioritization in terms of what's wrong in the world and go work my way backwards from that, right? So address conflicts at first and reduce them or eliminate them. Second would be to eliminate the opportunity for conflicts like this to arise in the first place, which means stop supporting extreme regimes around the world, defund them in every way possible. And third is to mitigate climate change and do it in such a way where everybody wins from it. And there's a way to do that. And instead of creating polarized views, polarized behaviors. But I think those would be the three priorities. So conflict, deconflict the world, number one. Number two, reduce power of the ones in charge that cause conflicts. And then third is mitigate climate change.
Awesome, Gary. Where can people find you?
LinkedIn, just my first last name, LinkedIn, easiest way.
Thank you. This was a very revealing and thought-provoking conversation.
Thank you. Thanks, Christina. I'm glad you had me on the show.